Coming up with another 25 basis point hike for investors to digest, we're going to discuss how to incorporate the rate rise into your investment strategy. Plus, our guests on set with me today are going to explain why they believe the events unfolding in Dubai highlight the need to gain exposure to the fixed income arena. I'm joined today by Dr. Stephen Nash, Head of Strategy and Market Development at FIIG Securities, and Robert Mead, Head of Australian Portfolio Management at PIM. Well, let's get straight to our guests now to see what they think about this decision. Rob, let me kick things off with you. You were expecting to see this rate hike by the central bank. Yeah,
we were. I think the RBA has been pretty clear about wanting to remove the emergency policy setting from 3 to now 375 is a material adjustment, but I think there's a little bit more to go. I think they'll be watching the data from now on, and especially watching moves like Westpac's today as an indicator of how much further they need to go. The bond market's taking Westpac's announcement very positively in the sense that there's less for the RBA to do if the banks are going to be moving on their behalf.
And certainly moving to the extent that Westpac did today. I mean, that's 20 basis points over and above the RBA.
Well, it's one of those things, and the opening comments suggested it, that the Australian economy, and as Wayne Swan said, is doing very well. And one of the impacts of that is we've got a growing economy and a growing banking sector that needs to be financed. And in a global market that is still facing elements of credit contagion, it's very expensive to finance that, and I think that's showing up clearly in today's rate move.
So do you think following this Westpac decision we're going to see CBA, ANZ, etc. moving?
I'd have to say that they'll all be inclined to move by more than the RBA now that Westpac's set the standard.
Would you agree with that, Stephen?
Yes, I think the banks have got a little bit of a difficulty in terms of funding at the moment, and that's reflected in these rate increases. I also think that, you know, we'll see the short-term rate trend up to around 5% next year in terms of the RBA rate. But I think the market had that basically built in and has rallied significantly of late in anticipation of some sort of move maybe towards the end of next year.
Do you agree with Rob in the sense that if we do see these, I guess, bigger increases coming through from our domestic banks, that the RBA may not have to go quite as far? Is that factored into your thinking when you're looking at your expectations going forward?
Yes, I think the more the banks increase their rates relative to the RBA, that will be factored in by the RBA for sure. And we've got a bit of a period of wait and see now before the next tightening. So it's going to be interesting because we've got this withdrawal of fiscal stimulation at the same time as monetary policy is being tightened. So I think next year you'll see the economy being stressed in a sense, and whether it comes through is an open question, I think. Yeah.
So you're expecting 5% by June?
During 2010, I don't know exactly about June. Yeah.
So throughout 2010, around 5%. 5%?
I don't think they get to 5. I think the neutral rate of the Aussie economy probably used to be 5.5. I'd say now it's more like 4.75, taking into account the higher cost of bank funding. And I don't think we need to go to neutral, given that the sort of global backdrop. But we'll push into at least sort of the mid-4s in 2010.
How quickly could we get to 4.75?
I think there's the RBA again its wording today suggested that they feel quite comfortable with the sort of 75 they've done. We all know they're not meeting in January, so the next rate move potentially is in February. I think they continue to move towards a sort of 4.25 rate, considering that was the low of the previous rate cycles, and was considered historically to be quite accommodative. But once they get to 4.25, 4.50, it becomes a bigger question mark in my mind, and then to get to 5 would be a stretch.
All right. Stephen, in terms of the Dubai world situation, what we're hearing from Dubai, is this something that you have any sort of exposure to within your portfolio?
Not directly, but a lot of the banks that we invest in have some exposures to Dubai world, and I think the general effect will be that credit standards will be even more tightly increased than they are now. So I suppose the theme going forward is that banks are going to be looking at their loan books more critically, and will be looking at any leverage more critically than they even have before. So less credit, basically, is the impact.
You're nodding there, Rob?
Yeah, I think I totally agree with Stephen. I think in any of these crises, it always ends up on the bank's balance sheets to some degree, and especially to the ones that are still sort of struggling under existing problem loans and other structured problems that had already been identified. This is just another sort of nail. But I guess the other side of the equation is that any levered assets or highly levered assets that have short-term maturity profiles, like we had in this case, sort of subject to the markets deciding, okay, game over, in a heartbeat. So I think that's just a warning sign for all risk assets that you need to be very cautious in regard to just assuming things go on business as usual as a going concern when it comes to rolling over large amounts of funding. It will be increasingly difficult.
How significant is this issue? I mean, we're talking about, you know, funding becoming more difficult, but how quickly is the market likely to feel the impact of this, and how widespread is it?
I think very high quality credits, and we already talked about the Aussie banks. I think even though they've got very large funding tasks, they're very, very high quality underlying businesses, and they will be able to fund themselves without any question, but they'll just be forced to pay a higher cost than they would have sort of pre-global financial crisis. Other credits or other companies that don't have such strong fundamentals may just find it's a binary decision that the switch is fully turned off, and unless you get support from elsewhere, it's not available.
Yeah, and I think just moving on from that, getting alternative finance is going to be increasingly difficult. You know, one bank says we can't continue this particular loan. Other banks probably have a very similar story.
What does this mean for your portfolio in terms of your strategy, investment strategy?
Well, I suppose you've got to remain fairly conservative on credit right now. I mean, spreads have contracted a lot. We don't think this is the time to get aggressive on getting extra yield. So we'd probably prefer to stay with the senior bank debt at this stage. There has been a bit of a blowout in the hybrid space, so you can take advantage of that by maybe selling subordinated debt and buying the hybrids. That's one possible play at the moment.
Is that something that you're doing?
Broadly speaking, I agree. I think it's one of these times when you need to be very aware of the underlying sort of fundamentals of what you're investing in. I guess we're very lucky as Australian investors to have a whole multitude of very high quality corporations, very high quality banks, and also sort of the broader RMBS market with an underlying strongly underpinned residential property market. Maybe it'll be under a little bit more pressure after today, but nonetheless it's a very secure underlying cash flow stream. So I think focusing on sort of investments that have an Australian flavour will continue to be sort of beneficial and pay off in the long run.
So it's a real call to stay at home for Australian investors.
And to pick your spots. I think from our own perspective, buying sort of Australian bank bonds denominated in things other than Aussie dollars are extremely attractive to Aussie investors versus how they're priced in Aussie dollars. So those sorts of opportunities continue to be out there and are quite compelling.
I mean, if you look at a typical portfolio that has, say, 60% equities and compare that to another portfolio that has 60% bonds, basically flipping over the typical equity allocation, you can quite substantially cut your risk by having a fixed income bias portfolio as opposed to an equity bias portfolio. Yes, you do trim returns somewhat, but the main impact is risk, and the return stream is much more conservative. So it's probably the way to go going forward.
Certainly with this increase in volatility expected to come through in the markets.
Yes.
Absolutely. All right, let's get straight back to our guests, and we are of course talking about the bond market here. Stephen, let me jump right back to you. We've been talking about various investment strategies, trading themes within this market, longer semi-government bonds.
Yeah, well, what's happened there is that the spread between the semi-governments and the governments is quite wide. We've had a spread contraction in most other interest rate products, but that has remained reasonably wide. So it's one of the few areas of value that's left at the moment because the market's contracted so much in spread.
And how long is the opportunity, do you think, for investors to get involved in this trade?
Well, it really depends on what happens with what they call the bond swap spread, and that's really a demand-supply issue in terms of bank funding. At the moment, banks are under a bit of pressure, so I imagine the bond swap will remain wide for a while.
For a while, okay. Rob?
Yeah, I agree with that. I think there's a fair bit of sort of offshore buying into our Commonwealth government bond market, which has sort of bid up the levels of those securities versus just about everything else that's available. so leaving swap spreads behind and some of the semi-government and supranational bonds behind. And the semis do stand out as being sort of very attractively priced versus Commonwealth. Also actually just like the front end of the swap curve, any time that the market's pricing in sort of more rate hikes than we believe will play out provides a great opportunity. As it's probably not as good an opportunity now as it was about an hour and a half ago, but it is still, I still think there's some mispricing there that should be taken advantage of.
Well, we still don't have a consensus, do we, as to what's going to happen in February?
No, not yet. There's a lot of time to pass by before they need to act again.
Alrighty. Okay, well, we are out of time. Thank you both so much. Thank you. Dr. Stephen Nash with me from FIIG Securities and Robert Mead from